When the dot switches to below the candle, they take long positions. And when the dot switches to above the candle, they take short positions. Now, despite this being a famous strategy, there are actually a couple of problems if you use the indicator this way. Firstly, the Parabolic SAR is a trend indicator, meaning it only works on trending markets. Remember, markets aren't always trending. It can also move within a range. And because the Parabolic SAR is constantly showing signals non-stop, it means that it'll also show signals even when the market isn't trending. Let me show you an example. Here, we can see that the Parabolic SAR switches to below the candle, indicating that the market is on an uptrend. And according to the strategy, we take a long position here. Next, we can see that the trend has ended and the market started moving sideways. However, notice that the Parabolic SAR is still displaying entry signals even when the trend has already ended. And as a result, all the signals that the indicator displays on this ranging market ends up being a loss. So in short, the Parabolic SAR only works on trending markets. If the market is on a range like this, it will display many false signals. The second problem with using the Parabolic SAR this way is that it doesn't take the long-term trend into consideration. Let me explain. So let's say you enter a short position here because the Parabolic SAR switches to above the candle. Now, if you zoom out and look at the overall chart, you can see that the overall market is actually on an uptrend. So if you took a short position here based on signals from the Parabolic SAR alone, it means you are actually trading against the overall trend, which is not a good idea. And that is why the solution to this is you need to combine the Parabolic SAR with another indicator that can detect the long-term trend. An example of that would be the 200 period exponential moving average. So here's how the full strategy would work. The first step is you want to identify the long-term trend. And you can do that by looking at the position of the price relative to the 200 EMA. For example, if the price is above the 200 EMA, it indicates that the long-term trend is up. And if the price is below the 200 EMA, it indicates that the long-term trend is down. Now, once you've identified the long-term trend, the next step is you want to wait for the Parabolic SAR to show the same signal as the long-term trend. For example, here, we can see that the price is below the 200 EMA, indicating that the long-term trend is down. This means that we're waiting for the Parabolic SAR to also show bearish momentum by waiting for it to go above the candle. Once this happens, you take a short position. Now, it's the same for long positions as well. Here, we can see that the price is above the 200 EMA, indicating that the long-term trend is up. Next, you want to wait for the Parabolic SAR to also show bullish momentum by waiting for it to go below the candle. Once this happens, you take a long position. And so, by simply adding the 200 EMA into the strategy, you can now safely trade the Parabolic SAR while making sure that you're still aligned with the long-term trend. Now moving on. Besides using the Parabolic SAR as an entry strategy, you can also use it as an exit strategy as well. And one of the most common ways that traders use it as an exit strategy is by simply waiting for the Parabolic SAR to switch positions. Let me show you an example. So here, we can see that the price is above the 200 EMA while the Parabolic SAR is below the candle. And according to the strategy, this would be your long entry. Now for your exit strategy, you can let the trades run until the Parabolic SAR switches positions. So once it switches, you can exit your trade. However, by doing this, notice that the price had already made a significant downwards movement before the Parabolic SAR displayed an exit signal, meaning you already lost a portion of your profits because of the late exit signal. And so what if I told you that there's a better way?